So we're going to split this presentation up into two portions. I'm going to go first here and talk about leases and GASB 87, and then really kind of compare and contrast and dig into SBITA, which if you haven't heard of that, we'll get into that here in a moment. So a little bit of information there as far as my bio. I'm a partner here with the firm and been here for 24 years. And Teena, if you want to make a comment or so on your bio, and then we'll move on. Teena, you're muted there.
Did click. I guess I didn't click in the right spot. I am an audit manager here at the firm, and I've been with the firm for almost 20 years.
All right, thank you. So to dig into things here, again, I'm going to go over the leases and SBITA. Teena is going to talk about a few GASB updates for some smaller standards, and then looking ahead a little bit into the future. There is a significant standard that has been an exposure draft for a little over a year at this point, and it's going to have some pretty substantial changes to the reporting model. So we're going to scratch the surface on that a little bit just to look ahead into the future. So digging into the leases, what I want to start with here is to just talk about timing a little bit. And on the next slide there, thank you, Christina. So just to compare and contrast timing, for those of you who prepare financial statements in accordance with Governmental Accounting Standards Board standards or GASB, you should have already been through the process of 87 or going through that right now. That was effective for years ended June 30th, 2022. Or December 31st, 2022, depending on your year end. So that process is already in motion and you're pretty familiar with that. We're not going to rehash everything with leases today, but really kind of compare and contrast and dig into GASB 96 for SBITA, which is subscription-based information technology arrangements. I'm going to refer to that as SBITA throughout the presentation here. So essentially a 1-year delay for the implementation of that standard. That is effective here for your June 30, 2023 year ends, and then December 31st, 2023, if that is your year end. So getting into definitions of the two, on the next slide, please. The definition of a lease, and for those of you who have been through this, essentially it's an agreement where between a lessor and a lessee, and it's conveying the control of a right to use another entity's non-financial asset. There's an underlying asset to it. And then this element of control, which we'll talk about here in just a second for the SBITAs. So the SBITAs, obviously a little bit different here. We're not talking about a physical, tangible asset, but the concepts here are essentially the same, where it's a contract that conveys the control of the right to use another party's or SBITA vendors IT software, and that could be a loan, a contract just for the software itself, or in combination with a tangible capital asset, and that has some ramifications that we'll talk about here in a few minutes. So this element of control, frankly, I think in some cases that created a little bit of confusion and judgment involved with leases to determine, do you really have control of the asset? But frankly, I think that's going to be a little bit clearer with the software, the SBITAs, and essentially that control, to convey that control, you have the right to obtain the present service capacity from the use of the asset and the right to determine the nature and manner and use of that underlying IT asset. Now, you might be saying to yourself, well, wait a second, we don't control the development of the software or the coding of it or the design of it. And that's not what this is getting at. Essentially, with that contract, if you have the right to use it and determine when or how you're going to use it, then you have that control. So I think that's going to be a little clearer than it necessarily was for the leases. So we're going to compare and contrast some terminology and some of the accounting a little bit here between the leases and the SBITA. So for a lease, we're all familiar with that. You have a lessor and you have a lessee. The standard for GASB 87 actually gave you the accounting processes for both of those situations. In the concept of a SBITA, here you have a vendor and then the government who is obtaining the software and using that software. GASB 96 actually does not have any standards there for the vendor itself, and kind of rare where that's a circumstance where a governmental entity is going to be a vendor for software. It does happen, but certainly more rare than a lessor or lessee kind of situation. So GASB 96 is strictly for that end user or recipient of the software. So the intangible right to use asset that's part of these transactions for leases, it's a lease asset. For SBITAs, it's a subscription asset. The underlying asset itself, obviously, those underlying capital type assets for the leases. Here you're having the underlying IT assets or the software. And then the terminology for the liability is a lease liability or a subscription liability for the SBITAs. This slide, and I'm not going to walk through all of these bullet points, but what I want to talk about here, and we'll get into this a little bit more, is essentially the underlying terminology, the underlying accounting, the processes of how you accumulate this information, prepare the information and the calculations for SBITA is nearly identical to the lease accounting. There is one key difference that we're going to hit here in just a moment. But in terms of all that processing, if you went through that with GASB 87, then you're going to be familiar with this for the SBITAs. So the first question is the contract, you have this potential contract for software. Do you have to implement GASB 96? Do you have to take that into consideration? So really the easiest way to look at it is to say, well, what is excluded? What is scoped out of GASB 96? Well, first off, if the contract is purely to provide IT support services and it's not an actual underlying software, then this standard, it does not apply to that. That would be something that you would be expensing, as you incur it. And we'll talk about splitting apart transactions and the importance of that on a few slides. Possibly the contract could be to convey the use of a software, but it might be in combination with an actual tangible capital asset. And we see that quite a bit where it comes as a package. You're buying an asset, but you need a software in order to operate that asset, or maybe leasing the asset. So in that situation, then you really have to take a look and say, well, how significant is that software component? If the software component is insignificant, not material to the overall transaction of this combination of a tangible capital asset and a software, then you can essentially ignore that piece of it. And either if it's very, very small, it'd probably be rolled up into the lease transaction, or possibly just expense it as you go. However, if it is significant, then you're going to have to take that into consideration. So definitely some judgment involved there, no bright lines, but that is something that you'll have to think about if you have those combinations of contracts. Again, if the government's providing the right to use their IT software to someone else, that's scoped out. Again, this does not provide information for vendors of governmental software. There's a concept of what's called P3 or public-private partnerships, public-public partnerships, and availability payment arrangements. We're not going to get into that today. It kind of has some limited applicability. If you do have those kinds of arrangements, GASB 94 is what dictates the accounting for those. And then finally, what is scoped out here is if you have a perpetual or permanent license to use software, and that certainly is out there. If that is the case, then GASB 96 doesn't apply. That's really looking at a temporary time period for implementation of the software. But GASB 51 actually would apply for intangible assets. And frankly, that's something that you should already have been accounting for within your records if you have a permanent software license. So we're going to talk very basics here in terms of the accounting. And again, a little bit of compare and contrast here with the leases and the SBITAs. So the initial reporting, and I'll say first, when you do this accounting, whether it's the leases or the SBITA, essentially there are three key elements that you need to know in order to do these calculations. So you have a transaction. The transaction is going to have a particular term. The transaction will have future payments that are required over that term. And then you have a discount rate. And there's some other elements that come into the equation, but those are the three key elements that you need in order to do these calculations. That might sound simple, but if you've gone through implementing these standards, not always quite so simple. Sometimes the discount rate can be a little bit difficult to obtain. And frankly, what we found as one of the most confusing elements of implementing GASB 87 was in certain cases determining the term of the transaction. Certainly if it was one term, say 5 years, that's pretty cut and dry. But when you get into those renewal provisions and termination provisions, that's where it really creates some difficulty in determining what the actual term was, and in many cases required some judgment. The other thing that I like to say is, lease agreements are written by attorneys for attorneys, no knock on attorneys, but they're not necessarily written by attorneys for accountants. So getting into some of that legalese creates some headaches as well at times. So in terms of the initial transaction, talk about leases, you're looking at calculating the liability first. So you've got that future payment stream, and we're all used to present valuing techniques. So you're using that future payment stream, the term, and the discount rate to discount that back to the initial implementation date, and that's your lease liability. The intangible right to use asset then essentially is the offset of the liability, plus any kind of prepayments and any ancillary costs that were to put the asset in service. So to compare that with the subida, same exact concept for the calculation of the liability. You have a subscription liability, that's that present value of that future expected payment stream. The intangible right to use subscription asset, very similar, but a difference here. It's offset first by the subscription liability, any kind of prepayments, and then this new concept, capitalizable initial implementation costs. And I mentioned that earlier, but that is the significant difference in the accounting that you have between the leases and the subida. So as far as subsequent reporting, after you have that initial implementation, the initial recording of the leases or the subida. So just to talk about the leases, obviously you're making payments. Well, as you make those payments, we're all used to this. Part of it is a reduction of a principal of the liability, and part of it is interest expense. On the flip side, the right of use asset, that's going to be amortized over the shorter of the useful life of the asset or the lease term, whichever is shorter there. On the subida, similar concept. You're making payments, you're reducing that liability by a principal portion, and you've got interest. And then that's a subscription, right to use subscription asset, again, amortized over the shorter of the useful life of the actual IT asset or the subida term. So another slide here, again, just to focus on this new concept on the capitalizable implementation cost. So that subscription asset for the subida, again, you're starting out with the liability for the present value of the future payments, plus any payments made at or prior to the beginning of the subscription term, minus any kind of subida vendor incentives that were paid. And not necessarily you're going to see that often, but that could be the case. So those three pieces that's all exactly like the leases. Then you have the certain capitalizable implementation costs that need to be added to get to that subscription asset. So the next slide just gives you a little bit more information from the standard itself. So it introduces these three concepts of implementing a software program that you would have through a subida contract. So you have the first stage, the preliminary project stage, and that's essentially exploration. You're determining what software program that you're going to implement. So you're reviewing alternatives, maybe having demos, viewing demos and that sort of thing. If there are costs associated with that, those are just going to be expensed as incurred. Then moving to the last stage, the third stage, the operational and additional implementation stage. Well, that is after the software is in place, it's implemented, but there's still costs being incurred. There's training of users that are happening, maybe some data conversion, not necessarily to get the software up and running, but some data conversion that's required after the fact, maintaining the software, the hardware. That stage, that third stage, is also expensed as incurred. So it's this middle stage, this initial implementation stage, costs that are incurred in that territory, that's what's going to be capitalized as part of the subscription asset. So any kind of cost if you have some internal design of your systems to get this software in place, coding, installing, testing within your own system. If there's data conversion that's required as part of the implementation of the software, that area of cost, that's going to be capitalized. Now, at the initial implementation stage, you don't necessarily need to go back in time and accumulate those costs, but any kind of new submitter that comes online, this is something that you're going to want to capture. And again, this is a new concept, so I would venture to say that it's very unlikely that you have anything currently set up in your accounting system to track these costs. And if it's insignificant, as we always say, and GASB will always say, if it's not material, you don't need to implement. So if it's insignificant, not something you need to worry about, but that's a judgment call on your part. And if there's any significance to it, that is something that you're going to want to capture and book as part of these transactions. So
hey, Craig, we have a, excuse me, we have a hand raised. I'm going to see if she has a question.
Okay. Looks like we have Cynthia here. If you're muted, if you can unmute. And if not, you can certainly ask your question in the chat and we'll address that. So we'll go ahead and keep moving here and we'll pick up any questions in the chat. So the next slide talks about, I have a slide here dedicated to the subscription term. And I want to spend a few minutes on this mainly. And I said before, as we implemented GASB 87 for the leases, this is what we found to be one of the more challenging aspects of that. So this is not different than the leases, the concept of this term for the submittas, but to walk through this. So how do you calculate the term and why is it difficult? Well, it gets into renewal provisions and extensions of the term is where it becomes difficult in determining what your actual term should be. So the first part that you take into consideration is the non-cancelable term of the contract or the transaction. That is always your starting point, and that is included within the term. After that, and that's pretty cut and dry. That should be pretty cut and dry within the agreement. Well, then after that, you're looking at extension or renewal provisions or vice versa termination options. So you have these options, and the key thing to remember here is it has to be an either or. It can't be both parties having the option. So if both parties can renew the contract or force a renewal of the contract, or if both parties can terminate with certain time periods and that sort of thing, then those periods you don't take into consideration with your term. It's got to be an either or. So if you go across the slide there and you add the elements of the term, well, it's the option to renewal if the government has that option and they're going to exercise that option, or an option to terminate by the government and they're not going to exercise that option. Vice versa, if it's just with the vendor for a submitta, where the vendor can force essentially a renewal of the contract and they're reasonably certain to exercise that, or the vendor can terminate the contract on their own and they're not going to exercise that. So look, kind of wordy there, but that's what you have to take into consideration for the term. So one thing to think about, and I think what we're going to see quite often with these submitta contracts, is in many cases, they're going to be annual contracts. And we'll get into discussion of short-term submittas here in just a moment and the importance of that. So on the next slide, let's say that you are evaluating some renewal provisions, and it's an either or option, and say it's at the option of the government whether or not you're going to renew this contract. So you need to consider how many of these renewal periods are we going to take. And I will say that isn't something that your auditors can tell you. That's a judgment call that you'll be making on your own to determine whether or not you're going to take this renewal period. So the standard does lay out a little bit of a pathway to help make that determination. What factors do you need to take into consideration if you're going to exercise that renewal option or terminate? Some of the things that it talks about are, what's the rates of your contract in comparison to the market? Do you have favorable rates with your contract? Well, that might be something that would lean you towards exercising those renewal provisions. Are there changes in technology? Maybe the software that you have is now outdated in comparison to something in the market. And obviously that moves very quickly and could be the case. Well, in that situation, probably not necessarily going to renew the contract. What's your need for the software? How important is it to your operations? There could be some disadvantages if it's a termination provision. Could be some disadvantages to terminating, maybe some costs that are incurred, exit costs, or a penalty per se of terminating the contract. What's your history of exercising these renewal provisions? Those are factors that you need to take into consideration and determine how long are you going to use this particular software when you're thinking about those renewal provisions. So the next slide talks about, and I mentioned this earlier, short term. And that is a word that you want to absorb when you're thinking about leases and the subita. So the significance of that is if you determine that it is a short-term subita or short-term lease that we had for 87, then essentially all this complex accounting, all the additional footnote disclosures, all that kind of goes away. And at that point, you're really just expensing the transaction as you go. So this is a key thing that you want to take into consideration. So what is a short-term subita or lease? And in that situation, the maximum possible term at the commencement of the transaction is 12 months or less. So it's not a key thing to keep in mind. It's not what you think you're going to take in terms of the renewal provisions, but it's the maximum possible term that's within the contract. So if there are renewal provisions that you can take and they're in that either or category and that goes past 12 months, well, the fact that it's just an annual subscription doesn't matter at that point. It's possible that it's greater than 12 months. So it's going to be a long-term or other contract where you're doing the complex accounting. So that's a key thing to keep in mind when you're thinking about a possibility of a short-term contract. Next slide here talks about separating components of the contract, and I hit on this briefly earlier, where I think we're going to have a lot of cases where these software contracts include a support component to the contract. And in that case, really that support, the cost of that support component needs to be broken out separately and accounted for separately from the actual subita transaction. That's not different from the leases. We had that there as well. And so same thing, you're going to look at materiality. Is it significant? If it's not significant, then you could potentially just keep those dollars within the accounting for the subita. And it also kind of lays out in the standard, if it's just absolutely not possible to break out that contract, then you can continue to include it with the subita. But if there is a separate component, whether it's support or anything else, then that does need to be broken apart, and you're looking at allocating that contract price to the process of doing the calculations. The discount rate, we talked about this a little bit earlier, as something that may be a little challenging to get at times. So with leases, there was always a possibility of contacting the vendor and the vendor providing the actual discount rate, and in some cases that was successful. With that is still there as a possibility for the subitas. I just think that it's going to be very difficult, for a software vendor to say, oh yes, we're charging you 3% interest or 5% interest. They're just not thinking of a transaction in those kind of terms. So I think it's very unlikely that the vendor is going to be able to provide a discount rate. So in that case, you're really falling back to your own incremental borrowing rate to determine what rate you should be using. Or ultimately, if that's unavailable, say you don't have debt, then you're looking at using market data to obtain that rate. So just a few questions here, common questions that could be helpful, and then we'll move on to the other GASB standards that we're going to talk about. So one question that comes up quite a bit is, with the subita, and this is the same for the leases, do you have to go back to the initial, at this implementation time, do you need to go back to the start of the transaction? So in the case of subita, let's say we're looking at, it's a June 30, 2023 year end. So let's say we're looking at July 1st, 2022 as the implementation date. Well, if you had a subita that started 3 years earlier and maybe it runs for 5 years, do you have to go back to that 3 years ago? No, you do not. And in fact, you're not allowed to go back to the beginning of the contract. You're looking at that stream of payments from July 1st, 2022 moving forward. So in that scenario of a 5-year contract, you really only be looking at 2 years. One thing to keep in mind there as well is, let's say it was a 5-year contract, but as of July 1st, 2022, you only have 1 year left. Well, in that case, it's a short-term subida, and that's not something that you would need to account for, because you're looking at the facts and circumstances in effect at the date of implementation. And then finally, on the next slide, just talks about the MD&A, something that we all love to prepare, I'm sure. But the question is, if you have single year financial statements, well, obviously you're doing all the calculations only for that single year, but in the MD&A, there you have comparisons and you have comparative data for the prior year. Do you have to go back just for the MD&A and redo these calculations strictly to show it in the MD&A? And the answer to that question is no. You do not need to go back and restate that prior year within the MD&A. If for some reason you have that data and you want to, there's nothing stopping you from that, but you do not have to restate that prior year in the MD&A. So I will turn things over to Teena, and we'll dig into a few far less significant GASB standards.
All right. Hello, everyone. So the last few slides that we have are talking about standards, a couple standards that have been finalized, but are still in the process of working on being implemented. And then there's one that is in the works that is not finalized yet, but we expect it to be finalized here shortly, likely this year at some point. And then the implementation, obviously they give you some time to kind of digest the standard and what changes will need made before you have to officially implement it. But the first standard that actually has been passed and will need to be implemented here, basically after 96, that we're talking to all of you guys about. The next one that will most likely impact a lot of you on this session is GASB number 100, and this is accounting changes and error corrections. So this standard and the next one I'm going to talk about, it's nothing new, and there's no drastic changes that are going to come out of these standards and implementing them compared to what you're already doing. More so just a lot of them are based on older standards. As you can see, this one is an amendment of GASB 62, and we're now at 100. So it's been a few years since the original standard has come out. So they just kind of took a fresh look at some things and made some minor tweaks and adjustments and implemented a new standard in its place. So this one here, the effective date is for any fiscal years beginning after June 15th of 23. So for most of you on this session, that would mean calendar year 2024 or 12/31/24 or fiscal year end June 30, 2024. Earlier application is encouraged, meaning you can implement this earlier if you'd like, but you don't have to. The dates right above that would be the absolute implementation date for you. What this standard includes is accounting changes and error corrections. So the accounting changes, you could have a couple different possibilities that fall under the category of accounting changes, and you can see what they are there. For any of you who had to implement GASB 87 for leases, that was a change in accounting principle that was acknowledged in your financial records. So that would be the same that you would be accounting for here for GASB 96. Now, the implementation of GASB 96 is before this standard's applicability, but again, nothing too significant as far as the difference between what the result would be as far as what you're going to report. And then the error correction. So that is just everything else, any kind of misstatement, whether something should have been reported in the prior year but wasn't, or was reported in the prior year and shouldn't have been, those kind of things would also be covered under this standard and how you would implement it. We're expecting this to have pretty minimal impact to our clients, especially from an internal standpoint, as far as requiring adjustments, journal entries, things like that. A lot of it will be more external, disclosing in financial statements the information that is causing it, things like that. So no major impact, but it is something that right here coming up in this next year that you will be needing to implement if you have any of these situations. The next one is Statement 101, and that is compensated absences. So again, nothing new. A lot of you are already reporting compensated absences, but just kind of refresh look that they took on the standard and have some updates for it. The effective date for this is for years beginning after December 15th, 23. So calendar year 24 again, but for fiscal years, you would be for June 30 ends, it would be June 30, 25. It includes leave for employees that could be any of the following you see there. Cash payments for regularly using time off, meaning regular payroll processing. Other cash payments, meaning paying for unused leave at the end of employment, and any non-cash activities such as conversions to OPEB or other post-employment benefits. And it also includes certain salary-related payments. For the most part, that means any taxes or anything else associated with the payments that are above. This is just a list of examples of leave. The three obviously most common ones, vacation, sick, and just the general paid time off or PTO, but there are other applicable leaves that would be covered under this standard. So when do you have a liability? You have to ask yourself a couple questions. Does the absence accumulate? Is it attributable to services already rendered, meaning is the employee earning it? Have they already earned it? It just wasn't paid yet. And is it more likely than not that it will be paid or settled through other means for likely the conversion that we talked about? So the general rule is you recognize liability for that leave and any related payments to it when the leave is earned. You do not need to report all of the liabilities together. If you're thinking about a line item on your financial statements or an account in your accounting system, you could separate them out based on the type of leave they are. So for example, if it's salaries payable for an accrued wage, that could be broken out and reported separately than the actual compensated absences for leave that has not been used yet. Also, if it's more likely that the leave will be paid out at a different rate, you want to use that different rate to measure the liability. So a perfect example of that is if your policy states that sick leave is accrued, but when it's paid out at half the rate of the employee, then you would use half of that rate, that employee's rate, to calculate the liability. You wouldn't be recording it at 100% because that's not what you would be paying out based on your policy. And any changes that happen throughout each year to the rates or the number of days that we paid out, whatever the case may be, that's recognized in the period of change. Note disclosures, you can either separate the increases and decreases during the period, which is normally how it is now, or you can report a net increase or decrease as long as you indicate that that amount is net. And then just informational here from a restatement standpoint, you would be following the new GASB 100 guidance to report that change in accounting principle when you're implementing that standard. As far as current projects are concerned, we have the big one, which for if any of our clients are on this call here, we've been communicating this to you for a number of years now because it's been in the works for a number of years. But it's the financial reporting model. And this has been a very large upcoming standard that the board has been working on for a very long period of time. They're in their second round of exposure draft and deliberations, but we are expecting the final standard this year at some point. I think the goal right now is December of 23. So this is just a listing of the proposed changes that they're looking at, some more significant than others, but these are kind of the big ticket items of things that they are looking at in that standard. Next slide. Okay, so this standard, you can see they're re-examining a number of previous standards. That's why this is so significant. And especially that first one there, GASB 34. If any of you require that, that standard to be part of your financial statements, you know how significant that is, the impact, the changes, all the conversion activity that's needed to get that information from the required information from that standard in there in your financial statements. So obviously that's one of the reasons why this is expected to be a pretty significant impact again once this standard is finalized. They are looking, they do have a revenue recognition, revenue and expense project that they're working on as well. They're trying to do these as in tandem as possible just because of the impact that it's going to have. But that is going to be a separate standard. And the main areas that are being reviewed, you can see there, the big one, short-term focus for the governmental funds, that is obviously we're expecting to be pretty much one of the largest changes and impacts of the standard, but there are some other things that they are still reviewing. So looking at the short-term focus for the governmental funds, what they're looking at is a recognition period of anything that should be just 1 year. So you're looking at the short-term method being anything within 1 year, and the method should be based on the inception date of the transaction. So the terminology they're using is very much transaction-based. It's individual transactions when the transaction was initiated. And so there's going to be a little bit more thought that's going to need to go into the reporting of a lot of your transactions because of this short-term focus that they're going to be implementing or likely implementing. Another change, the management discussion and analysis, the MD&A that Craig mentioned earlier. Everyone loves that section. There are going to be some changes to that section. One thing that they're looking at is not requiring an analysis of non-major funds. Another potentially large change is where in the MD&A you're looking at and disclosing, documenting significant variations between the original and final budget and the final budget and the final actual results. They're looking at including that as notes to the budgetary comparison information that's in the financials, and including all of that as required supplementary information, or RSI that we call it. That's all we have for our presentation of current and upcoming GASB standards. If there's any questions, we can field them now.